Most people find out they're behind financially the same way, slowly, then suddenly. They're living their life, things seem fine, and then at 48 they look at their retirement account and realize they have $90,000 and they need $1,500,000. The math doesn't work. The timeline doesn't work. And they have no idea where the plan broke down. Today we're going to prevent that realization from being yours. This is the wealth building checklist by age, not a vague suggestion, not a feel-good framework, but specific milestones, specific accounts, specific numbers for every decade of your financial life. Run through it. Know where you stand. The foundational years are ages 22 to 25. You are not expected to have large numbers here. You are expected to put the infrastructure in place. Every month you delay building this foundation costs you in compounding, and compounding losses in your early 20s are the most expensive losses of your financial life. Checklist for ages 22 to 25. First, build a $1,000 starter emergency fund before anything else. This is your buffer against the kind of disruption, a car repair, a medical bill, a gap between jobs, that forces people to take on high-interest debt. It does not need to be 3 months of expenses. It needs to be enough to prevent a spiral. Second, enroll in your employer's 401k and contribute at least enough to get the full employer match. If your employer matches 3%, contribute 3%. This is an immediate 100% return on every dollar contributed to the match threshold. Passing it up is the equivalent of declining a pay raise. Third, open a Roth IRA. In 2024, the contribution limit is $7,000 per year. You can contribute as long as your income is below $146,000 if single. At 22 years old, every dollar in a Roth IRA will compound tax-free for potentially 40 years. The Roth IRA is the single best wealth building account for young earners with low current income, because you'll likely be in a higher tax bracket later. Open the account at Fidelity, Vanguard, or Schwab. Buy a total market index fund. Set up automatic monthly contributions. Fourth, eliminate all high-interest debt, credit cards, personal loans, payday loans, before investing beyond the 401k match. Any debt above 7% to 8% interest rate is a guaranteed negative return on capital that outweighs expected investment returns. Fifth, build your financial knowledge. This is not soft advice. Read The Simple Path to Wealth by J.L. Collins. Read The Psychology of Money by Morgan Housel. Know your numbers, income, expenses, savings rate, net worth. Most 22-year-olds have no idea what their net worth is. Start tracking it quarterly. By 26 to 30, income has typically increased, lifestyle has stabilized, and the habits established in the previous phase begin to compound either in your favor or against you. This is the acceleration window. Checklist for ages 26 to 30. First, build your emergency fund to 6 months of expenses. 3 months is a minimum. 6 months is the standard that protects you through a job loss or medical crisis without disrupting your investment plan. Keep this in a high-yield savings account, currently yielding 4% to 5%, separate from your checking account. Second, increase your savings rate to at least 15% of gross income. This includes employer match. If your employer contributes 3%, you need to personally contribute at least 12%. The research on retirement security is consistent. A 15% savings rate from your mid-20s, maintained over 30 to 35 years, produces a retirement that replaces your income. Below 15% generally does not. Third, max your Roth IRA annually without exception. $7,000 a year. Set it and forget it. If you get a raise, the Roth IRA maximum does not change. Make sure it's filled first before lifestyle inflation consumes the difference. Fourth, if your 401k is maxed and your Roth IRA is maxed, open a taxable brokerage account for additional savings. This is your overflow vehicle. Use it for goals with a 5 to 10 year horizon, a down payment, a future business, bridge income before 59.5. Hold total market index funds here. Fifth, net worth target. By age 30, a reasonable benchmark is to have saved 1/2 to 1 times your annual salary. If you earn $70,000, you should have between $35,000 and $70,000 in invested assets by 30. Behind that benchmark? Increase your savings rate now. Every year of delay is compounding in reverse. The early 30s are the first major financial checkpoint. At this stage, life gets more complex: mortgages, dependents, larger salaries, more tax exposure. The checklist reflects that complexity. Checklist for ages 31 to 35. First, net worth target: 1 times your annual salary in invested assets. If you earn $90,000, aim to have $90,000 invested by age 35. This is the Fidelity guideline and it's the right order of magnitude. If you're significantly behind, this is your warning light. Increase the savings rate. Reduce fixed expenses. The gap is recoverable in your 30s. It is much harder to close in your 50s. Second, build a diversified portfolio beyond just your employer's 401k options. If your 401k menu is limited, use your Roth IRA and taxable brokerage for broader index fund access. A total U.S. market fund, an international fund, and a bond fund in the appropriate proportion to your age covers the core need. Third, purchase term life insurance if you have dependents. A 20 to 30 year level term policy providing 10 to 12 times your annual income is the standard recommendation. At age 32, a healthy non-smoker can purchase $1 million in 20-year term coverage for roughly $30 to $50 per month. Do not confuse this with whole life insurance. Term insurance is pure protection at low cost. Fourth, complete your estate planning basics. A simple will, durable power of attorney, and healthcare proxy. Designate beneficiaries on every account: 401k, IRA, life insurance. Beneficiary designations override your will. An account with a wrong beneficiary designation can send money to an ex-spouse regardless of what your will says. Fifth, review your income tax strategy. At this income level, consider whether pre-tax 401k contributions or Roth 401k contributions make more sense. If you expect to be in a higher bracket in retirement, lean Roth. If you're in the 32% or 35% bracket now, the pre-tax deduction is extremely valuable. The late 30s, done correctly, feel like the plan is working. The portfolio is large enough to generate meaningful returns. The contributions feel less like sacrifice and more like habit. This is the compounding zone. Checklist for ages 36 to 40. First, net worth target: 3 times your annual salary. At $100,000 income, that's $300,000 invested by 40. Fidelity's research supports this benchmark as the trajectory needed for a retirement around age 67 at a similar standard of living. 3 times by 40 sounds aggressive. It requires sustained savings discipline from 22 onward. But it is achievable and it is the benchmark. Second, max every tax-advantaged account available to you. In 2024, 401k at $23,000, Roth or traditional IRA at $7,000, and if you have a high-deductible health plan, an HSA at $4,150 for individuals or $8,300 for families. The HSA is the most underutilized tax-advantaged account in the American financial system. Contributions are pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free, the only triple tax-advantaged vehicle that exists. Third, the taxable brokerage should be growing meaningfully by this stage. Focus on tax efficiency, hold low turnover index funds, harvest losses when available, and avoid funds that distribute large capital gains. Fourth, if you own real estate, this decade is when many people add a rental property as a second income stream and wealth-building vehicle. Real estate returns are heavily influenced by purchase price, leverage, and local market conditions. It is not automatically better than index funds. But for the disciplined investor, a single well-purchased rental property can add meaningful cash flow and appreciation over 20-plus years. The 40s are the wealth optimization decade. the big contribution habits are set. The portfolio is large enough to be the primary driver of wealth growth. The focus shifts from accumulation mechanics to tax efficiency and risk management. Checklist for ages 41 to 50. First, net worth target 5 to 7 times your annual salary by age 50. At $120,000 income, that's $600,000 to $840,000. This is the range that puts you on trajectory for financial independence in your mid-60s. Below 5 times at 50, the retirement math becomes very difficult without either significantly reducing expected lifestyle or working longer than planned. Second, evaluate Roth conversions. If you expect tax rates to rise, or if you anticipate a lower income year, perhaps due to career change, sabbatical, or early retirement, converting traditional IRA or 401k funds to Roth in a lower bracket year locks in a lower tax rate on future growth. This is a complex calculation that depends on current bracket, projected retirement income, and state taxes. It's worth a one-time consultation with a fee-only CPA. Third, consider your mortgage payoff timeline. Paying off a mortgage before retirement eliminates a fixed expense, which dramatically reduces the income replacement you need in retirement. The math on whether to pay down a 3% mortgage versus invest in a 7% to 10% return environment generally favors investing. But there is a behavioral and psychological case for eliminating the mortgage that has real value. Housing security changes your risk tolerance and your emotional resilience to market downturns. Fourth, begin thinking about sequence of returns risk. This is the risk that a major market decline in the years immediately before or after retirement permanently impairs your portfolio. In your 40s, the mitigation is gradual. Shift your allocation slightly more conservative as you approach 55, moving from a 90-10 stock-bond split toward 80-20. The 50s and beyond are the final wealth-building chapter before distribution begins. The focus is on maximizing contributions, managing sequence risk, and making the single most important retirement income decision most Americans will face. Checklist for ages 51 and above. First, use catch-up contributions. In 2024, investors 50 and older can contribute an additional $7,500 to their 401k above the standard $23,000 limit, for a total of $30,500. The IRA catch-up is an additional $1,000 for a total of $8,000. These catch-up limits exist specifically because many Americans enter their 50s behind their target benchmarks. Use them aggressively. Second, build your Social Security strategy. The difference between claiming Social Security at 62 versus 70 is approximately 76% more monthly income permanently. For every year you delay past 62, your benefit increases by 6.25% to 8%, depending on age. If you're in reasonably good health and expect to live past 82, delaying to 70 is almost always the mathematically superior choice. If you have a pension or other guaranteed income, the case for delaying Social Security is even stronger. Third, construct a detailed sequence of returns risk plan. The first 5 to 7 years of retirement are the highest risk period. A major market decline early in retirement, combined with portfolio withdrawals, can permanently impair a portfolio in ways that later recoveries cannot fix, because you're withdrawing shares at depressed prices rather than accumulating them. Common mitigations: maintain 2 to 3 years of expenses in cash or short-term bonds, use a bucket strategy to separate near-term and long-term funds, and plan withdrawal order carefully, taxable first, then traditional, then Roth. Fourth, review all beneficiary designations, estate documents, and insurance policies. Your life has likely changed significantly since you first completed these. Beneficiaries should be updated after any major life event: marriage, divorce, birth, death. The wealth building checklist is not about perfection. It is about progress. If you're behind a benchmark, that is information, not a verdict. You can close gaps at almost any age with a higher savings rate and a disciplined plan. The people who end up financially secure are not the ones who had it all figured out at 22. They are the ones who looked at their actual situation, honestly, and kept adjusting. Run the checklist. Find the gap. Close it. Word count, 1 330 iteration, 10-minute end card, V50, your first million, the complete step-by-step roadmap.